Okay,
And now,
so just remind people, so the flexible spending account, what it did and what it does, employees basically can say, I want to put some money aside pre-tax, so it's deducted from your paycheck, if you will, put into a side account, and then you can use that money. Now, we're talking specifically right now related to medical costs that you can pay. Either you can use it to pay part of your premiums for the employee part of the plan, the employee contribution, or to pay medical expenses. We used to call these cafeteria plans because there might be a number of choices, but for most of them, they're flexible spending accounts because they specifically are related to medical costs. So again, this is a big change, particularly related to, again, having the penalty that if you use the money for something else that's not a qualifying expense, you're going to get hit with a pretty heavy penalty here.
absolutely. I'd say probably not doable.
Okay.
The other piece that I think is really critical here is the over-the-counter medicine that is now no longer eligible to be reimbursed on a pre-tax basis through this plan.
Now this is going to be effective when again?
This is effective in 2011.
Okay, so next
Okay,
year.
so we have in our country roughly 38 million people who are participating in some form of integrative or alternative medicine and healing type situations. And this is typically where this comes in: supplements, herbs, and these kinds of things. And they will no longer be eligible to be reimbursed other than if they are put on a prescription. So as one of my friends at an insurance company said, just get a prescription.
Yes.
I guess that's the solution, and I hope that doesn't carry with it the high prices that we have for some of the prescriptions that we deal with today.
So again, what we're talking about right now is you could pay with your flexible spending account in 2010. Basically, you could get an aspirin, or you could get a bottle of aspirin, and you could charge it to your flexible spending account. This is actually a fairly recent development that came out with some IRS rulings just a few years ago. But what they've had to do because of the cost of this thing, basically, is to tighten up a little bit. And so they're saying those over-the-counter type medications are no longer going to qualify. And so again, you need to get a prescription. And you were talking about the alternative health, so a lot of medical plans historically haven't paid for things. Well, they may not, for example, cover chiropractic, for example, as a popular, or acupuncture is one that my wife has been using. And so that's not covered on my plan. I'm paying that out of pocket. Anyway, but some of those will still be covered. It's just, again, these need to be prescribed.
Yes, and let me hurry up to say, Mike, that I'm not suggesting that you get your prescription pad out and write your own prescription.
Yeah.
Any kind of medication that anybody takes should be at the direction of their health professional and health provider.
Okay, let's move on.
In 2013, Mike, there's going to be a limitation on the amount of money that can be put into a flexible spending account, FSA, and that's going to be $2,500. And in the past, the limitation was set only by the employer, so that's going to be a change. 2014 is where we get some of the big portions of the act, and during that, in the insurance reform area, in 2014, all pre-existing conditions will be excluded. So everybody is in there. We did the children this year, and then everybody's going to be in 2014. And also, there won't be any annual limits or any restrictive lifetime limits allowed after that period of time. The employer mandate, which is to me, the big part of the bill that the employers are going to need to be paying attention to. And basically, let me say, first of all, that employers with less than 50 employees will be exempt from this mandate, so they won't be a part of that. And the way it's going to work is if an employer has greater than 50 employees and they do not offer coverage, and if one of their employees gets a tax credit, the employer is going to be fined 1/12 of $2,000 annually per full-time employee, excluding the first 30. Now, I'm not exactly sure why that happened, but that's the way it's written. If the employer has greater than 50 employees, they do offer coverage, and one employee receives a tax credit because the coverage is deemed to be unaffordable, the employer is going to be fined the lesser of $3,000 for each employee receiving the credit, or $750 for each employee.
Now, when you were saying 1/12 of 2,000, what that really meant was 1/12 of 2,000 per month, so it'd be 2,000 per year, right?
I'm sorry, yes, 2,000 per year, but it's assessed on a monthly basis.
Yeah.
And that's the same with the 3,000. That works
Yeah.
in the same way. And the definition of unaffordable here is I think, noteworthy. Defined as premiums for the coverage selected exceed 9.5% of the family income, or if the employer pays less than 60% of the premium for the employee. So some things there that people are going to have to try to plan for. I'm not exactly sure how you gather the information to do that, but that will be coming up in 2014. Also, employers will be required to provide an employer free choice voucher to their employees if they offer coverage, and the employee has income of less than 400% of the federal poverty level, and whose share of the premium exceeds 8% but is less than 9.8% of their income, and they choose to enroll in the exchange. Okay, so once you've taken yourself through those steps, you get to the place where you either have the voucher or you don't, and the voucher amount, interestingly enough, is going to be what the employer would have paid under the employer's plan for the highest cost plan available to the employee. Mm-hmm. Now, this could lead to some interesting situations for employees. For example, if I qualify for a voucher from my employer, and I receive the voucher, and then I go to the exchange and buy an insurance contract that is qualifying coverage, but it's less, the rest of the money I take into income. So in some ways, I'm not sure that this was planned out correctly, but maybe there'll be the wisdom of that will come to me.
Okay.
Sometime. Small business tax credits in 2014. This is going to be, I think, big. Employers with less than 26 employees that have average annual wages of less than $40,000, and they purchase insurance for their employees, and they pay at least 50% of the total premium, are going to be eligible for this tax credit.
And it's what is up to 50% of the employer contribution.
It's going to be 50% of the employee contribution, and it's going to be available to them for 2 years. Mm-hmm. Now, the full amount of the credit, this is a graduated credit, so you may or may not get the full amount, but if you have 10 or fewer employees with annual incomes of average of $25,000, you'll be eligible for the full credit.
Oh, I see.
Yeah.
So what's happening, though, is first of all, we've got a credit now, effective in 2010, but then it's going to be increasing in 2014.
Right. It increases, and it's then set as a limitation of when it's going to be over with.
Okay. Yeah.
Also, we have the benefit design requirements that are going to be put on everyone, and all entities must provide an essential health benefits package, and these will be designed at an actuarial value, which means that at some percentage of the actual covered expenses of the plan at 60, 70, 80, or 90%. So we'd have those flexibilities, and they're named, of course, bronze, silver, gold, and platinum.
Okay.
And there'll be cost sharing in these plans, which means the employee's share of what they pay when they actually go and get the services is going to be limited to $5,950 for an individual and $11,900 for a family. And these are the same limitations that we have for HSA qualified plans today.
Now, are these going to be like are they going to be indexed for inflation? Do you know, or
that I didn't see, but okay. I would suspect that they would be. That would make sense to me. That they do. Also, in 2014, we have the health insurance exchange that is going to be required by the states to create. If the states don't create the exchange, the federal government will come in and do that, and that is going to be an assemblage of market players.